is entirely on the officer to show that it is not at market value. One. Two, find out what is the market value and then do this. Incidentally, this is in a case where it is from one assessee, one undertaking to another undertaking. There can be a situation where there is a transfer or a sale from one assessee to another assessee. There you have 80 IA 10. 80 IA 10 gets incorporated in all sections again, like 10A, 10B, etc. 80 IA 10 envisages a situation where there is a transfer of or the sale of goods or services from one assessee to another assessee, and owing to the close connection between the two assessees, the profits are arranged in such a manner, or the affairs are arranged in such a manner that the claim is excessive. So I am transferring or I am selling goods to a sister concern. My concern is selling it to a sister concern, to a subsidiary, say. Owing to the close connection, I am an 80 IA undertaking, the subsidiary is a non-80 IA undertaking. So owing to the close connection, I try to ensure that I book higher profits. I book higher profits. There again, the assessing officer, if he is of the opinion that you are showing more than ordinary profits, can determine what should be the quantum of deduction under 80 IA, or for that matter under any of these series of sections which we are just about discussing. Again, here the onus is high on the assessee. It is for him to demonstrate. It is not on me to demonstrate that I am showing more than ordinary profits. Incidentally, this has become another big problem, because what happens is in many of the cases where they have referred to transfer pricing, the transfer pricing officer has found that the profits that are shown are more than the ordinary profits. ALP, the arm's length price according to transfer pricing is say 19%. The profit shown by me say is 30%. Now they say 11% not eligible for 10A, 10B, etc. Why? You have shown more than ordinary profit. Determining more than ordinary profit is different from determining arm's length price. First, they are two different concepts. Arm's length price, there are 5 methods, all funny methods. Right? I must cheat as much as you cheated. I must fudge my accounts as beautifully as you fudged. Why did you not fudge properly? He has shown more profit, no? Because he wanted bank loan, he wanted to go for public issue. So I must also do that. But then he went for public issue, I have to pay tax. My own money. What to do? Satyam showed 27%, brought it down to 3%. What happened? How did Satyam show 27%? How did it come down to 3%? Fortunately, you could have objected to Satyam being used as a comparable, because Satyam has AE transactions. So they are controlled transactions. But what happens if they are uncontrolled? This is again a problem. Now we are having very major issues there. In fact, there are some companies, interestingly in software, where what they call the PLI for determining the net margin, the PLI is shown at 80%. 80%, and that is taken as a comparable for me. Right? 80% is not normal, it is beyond normal. Now the other way, they are saying you have made super profit. Now first thing I don't understand. Are you doing this under transfer pricing, or are you doing it under 80 IA 10? If you are doing it under 80 IA 10, then find out what is ordinary profit. If you are doing it under transfer pricing, you determine arm's length price. They are two different things. For example, in 80 IA 10, I cannot take, see for example, we are doing the transfer pricing assignment for a company which is say engaged in selling motors. No, I am not able to find a comparable which is selling motors. So I have taken a company which is supposed to be a comparable, because I have to do it, which is selling castings. Really, that is the comparable. That is what I have adopted. This is what the department also agrees. You don't have any better comparable. Now, can you say that these are really comparable for transfer pricing purposes? Yes, but for normal purposes, the answer should be no. So that 80 IA 10 and 92C are two different things. I think department is getting mixed up, and we are taking the best advantage of it also, which I don't want to touch on now, because then I'll get into transfer pricing. That is no longer 80 IA 10. So again, the onus is on the department to show that you made more than the ordinary profit. They cannot use the transfer pricing results for this purpose. That's all. I will stop here. Interestingly, they say this is income from other sources. Best joke. Income from other sources, what? The difference, no? 19%, 30%, 11% difference is income from other sources. Is it unexplained? You only told me my sister concern paid me. My sister concern paid me for what? It paid it to me as capital? No. It gave it to me as loan? No. It gave it to me as sales? That is what I am saying. You are saying no. Then what did it give it for? It gave it to me simply. If they give it to me simply, I have kept it simply. What is the problem? How can you tax it? Anyway, I am a company. If I were an individual, at least you can say received without consideration. You can invoke 56. Where will you go? What will you do for a company? Nothing. They still go ahead and make these additions. That is one part of it. The next issue is regarding 80HHC versus 80IA or 80IB. Now this is more particularly compounded in the context of 80IB and it mainly arises as a result of 80IA9, which is also part of 80IB, made part of 80IB. See, I am computing 80IA for undertaking, the profit of the undertaking. I am computing 80HHC for the profit of the same undertaking, but for a different purpose because I am exporting, say. 80IA is because, say, for 80IB, say, is for because I am situated in a backward area. That same goods which I produce, a manufacturer produce in a backward area, I export, I am also entitled to 80HHC. Now the departmental contention is that you must first compute 80IA or 80IB, then while computing 80HHC, you must subtract the 80IA or 80IB profit, which is eligible for 80IA or 80IB. Thereafter, you must compute the 80HHC. Our claim is different. Now, incidentally, the view of the department is supported by the Chennai Special Bench of the Tribunal, and I must say that I appeared personally in that. Right? Went against SSE. Mark the words. On that SACSoft also, I only appeared. That I won. It's not that I lose all the cases. We do both. So Chennai Special Bench was against SSE. There was another special bench which was formed in Delhi, a larger special bench which also is against SSE in a case called Hindustan Mint. There is a decision of the Delhi High Court which is in 332 ITR 14 which is against the SSE. There is a decision of the Kerala High Court in 332 ITR 40 which is also against SSE. But there is one decision of the Bombay High Court in 332 ITR 42 which is in favor of SSE. Now see, all three decisions of the High Court are in 332 ITR only. Right? In fact, there is one case which I was seeing of the Supreme Court, not an income tax case though. It was a case on some other matter, where in the same volume there are two decisions of the Supreme Court, both running contrary to each other, and one judge is common. At least here it's better. They are different courts. Be happy. Now, the Bombay High Court, in my opinion, I am not to comment on correctness of decisions, but to my mind, they have appreciated the section properly. Now, I told you this whole issue arises as a result of 80IA9. Now, 80IA9 says profits and gains claimed and allowed as deduction under this section is not available under chapter 6A for any other, under any other provision of chapter 6A, more particularly part C, which is only in respect of deductions of incomes. And it goes on further to say, in no case shall exceed the profits of the undertaking. Now, if you take the Chennai bench, the Delhi bench of the tribunal, the special benches, the Delhi High Court and the decision of the Kerala High Court, well, they may be right, they may be wrong, I am not into that question. But they don't seem to have addressed one simple point. If the working is to be done, first 80IA, compute the 80IA, whatever profit is eligible for 80IA, subtract it in computing 80HHC, then how will the total deduction exceed? how will the total deduction exceed the profit of the undertaking? It can never ever exceed the profit of the undertaking. The Bombay High Court says, since this language is used, that means if you are going to subtract it in computing 80 HHC, you cannot give effect to the second part of 80 IA9, and therefore you are not to subtract. To my mind, that is the correct view of the matter. I will not go further on that subject because most of the issues on this are no longer surviving, excepting some of the old issues. Next is on 80 IB 11C, where one assessee constructs a hospital, another assessee buys the shares of that company which has constructed the hospital and continues to run the hospital, which is now going to claim the deduction under 80 IB. Now, first of all, if you take 80 IB 11C, it is very, very clear that there is no need for you to construct a hospital. All that is required is that you must be in the business of operating and maintaining an hospital other than in certain excluded areas. Now, so long as you are in a place other than excluded area, it doesn't matter as to whether you constructed or did not construct the hospital. Whoever constructed the hospital, if you are operating and maintaining the hospital, you are entitled to the deduction under 80 IB 11C. Next is a case where, again 80 IB 10, where the assessee is not the owner of the land, because these power of attorney transactions still go on. In fact, there is one wonderful decision of Supreme Court on power of attorney transactions. I do not know how many of you have had the time to read it. If you get the time to read it, it is extremely interesting. It says, if the power of attorney is for genuine business needs, then it is not invalid. It is valid. If the power of attorney is between relatives, it is not invalid, it is valid. Then when only will it be invalid? And they also go on further to say that all old power of attorney transactions stand protected. Hereafter, you should not do through power of attorney, but you can do a business transaction through a power of attorney, and you can also do a relative transaction through a power of attorney. That means I can do through a power of attorney. That's all. Right? This is like, I don't know if it will be right to comment. There is one decision of the Madras High Court which just come recently. In the case of one member of tribunal, he filed a case in the Madras High Court. His name is UBS Bedi, Uttam Bir Singh Bedi is his full name. My God, that's all I can say about him. It's difficult, very difficult person. Now, what happened was, he was senior to other people, he was sidestepped, and other people were elevated as vice presidents. Right? Now, the other people who were elevated as vice presidents, what he did was, he went to the CAT, Central Administrative Tribunal, and said the others should not have been elevated to vice president. I should have been elevated. And he also said the president of tribunal cannot write my annual confidential report. Madras High Court said president cannot write the annual confidential report. So the committee which was formed to decide the elevation to vice president may have been biased. We request the committee. We don't direct the committee. I'll tell you why the request comes. We request the committee to consider his elevation within 2 months from the date of this order, if possible. Request is because the person who sits in the committee is the president of the tribunal, the law secretary, and a judge of Supreme Court nominated by the Chief Justice of India. And the person who was sitting when he was elevated was Justice S.H. Kapadia, who is now the Chief Justice of India. So the Madras High Court dare not direct the Chief Justice of India to sit in the committee. But if you start reading that decision, first part is all fine. Up to paragraph 19 is wonderful. He won. Paragraph 20, they start writing about him, saying he is a member who is not fit to be in judiciary, he does not understand judiciary, he does not have common sense, he does not understand this, he does not understand this. We direct him to mend his ways. Now there are strictures by the Madras High Court. What does this committee do? Right? For an annual confidential report itself, they did not elevate him. Now High Court stricture saying that this man does not know how to behave while he is sitting in tribunal and still elevating him to vice president? Is it possible? I really don't know what he would have achieved out of this order. Now, most of these are like that. Department also does not achieve anything. We also don't achieve anything, but the quarrel goes on. Now, the next issue, power of attorney. I was telling you, power of attorney transactions, old, new, are still valid. That's why I started the topic. Now, coming back, the issue is, I am the landowner, you are the developer. Whether you need to be the owner also to get the benefit of 80 IB 10, the Ahmedabad bench of the tribunal, Radhe developer, says not required. Incidentally, just about 4 days back, this decision of the Ahmedabad tribunal has been affirmed by the Gujarat High Court in Radhe developers itself, yet to be reported in any website properly in its full text. But Radhe developers, Gujarat High Court says you don't have to be the owner of the land to be eligible for the deduction. Next issue is again on 80 IB 10. 80 IB 10 is a case where there was first a company. In 2005, it obtained an approval in March 2005. Its name got changed, so it applied for a fresh approval in June 2007, completed construction in March 2011. Whether 80 IB 10 will be available. If you obtained approval in March 2005, the calculation will be 4 years from the end of that financial year. That means by March 2009. But if you take the approval date to be June 2007, you get 5 years from the end of that financial year, which will be available even post the completion of construction, which is in March 2011. So the effective issue is, which is the date on which I have obtained approval. The law is absolutely clear. It says the date on which you took the first approval. It is there in the first explanation to 80 IB 10 itself. The date on which assessee took the first approval. That means here March 2005, 4 years from that end of that financial year would be March 2009. Therefore, the assessee will be squarely hit by the provisions of the first explanation and will not be eligible. Now, an offshoot of this, construction is deemed to have been completed when it is so certified to have been completed by the local authority. Now, there are many cases where I have applied to the local authority within that 4-year or 5-year time span. The local authority clears it later. They issue me the completion certificate later. Department says the date of the completion certificate will be taken. We are saying no, but plain language says the date of completion certificate shall be the date of completion. It is causing great hardship. In fact, there is one decision where we have argued and the Chennai bench has said that that will be retrospectively operative, so you will be eligible for the claim. In fact, in that case, the worst part was we went to local authority. Local authority said, I won't give because you have not completed. So I went to the Madras High Court, filed a writ. The Madras High Court in the writ said, no, you consider it afresh and grant if it has satisfied these conditions. They found it was satisfied and gave it to me 2 years later, ultimately, after all this fighting went on. Department says, I will take the completion date as that date. That date is beyond the stipulated time. So, the completion date should be the date on which you make the application saying that there is a completion, provided there is no major objection from them. Supposing you apply for completion and then they say you have not constructed anything at all, you have applied for completion, how can we give? You cannot say that is the date on which I applied, therefore give it to me. No. Substantial compliance, I think, should suffice. Next is a case again on 80 IB 10. The issue here is I have different issues which I have raised. One is, what if the assessee has some flats which are entitled to a private terrace, whether the private terrace is also part of built up area, because the condition in 80 IB 10 is that the built up area should not exceed 1500 square feet if it is other than Delhi and Bombay. Delhi, Bombay should not exceed 1000 square feet. Now, whether that private terrace is to be computed, because they have a beautiful method of working the built up area. Built up area means the built up area as measured by in the normal sense, including projections such as balconies, but including the balconies and then adding up the thickness of the wall, because that will not be measured, no. So they have some great definitions for that, leaving that private terrace whether it is to be added or not. There is a decision of the Chennai bench of the tribunal in a case called Sanghvi and Doshi, which is reported in 131 ITR 151, where the Chennai bench would say that private terrace is part of built up area. Now that again, another offshoot of this is, supposing in one residential project where I am claiming 80 IB 10, some of the units is more than 1500 square feet, some of the units is less than 1500 square feet, what happens? The Chennai bench again in Sanghvi and Doshi says you are entitled to pro rata deduction. This decision of the Chennai bench itself is a fallout of a decision of the Calcutta High Court in a case called Bengal Ambuja. Bengal Ambuja incidentally still remains unreported, but you will find a reference to that in the Chennai bench of the tribunal. So they say the Calcutta High Court has said pro rata, we are also taking pro rata. There are other decisions which also have talked about this pro rata business. Now, the other issue on 80 IB 10 which I have raised is, if you look at 80 IB 10, it would say you cannot sell more than one unit to an individual or to a person other than an individual, or if the person is an individual, you should not sell more than one unit to such individual or the spouse or to the minor children or to a HUF of which he is a karta. Right? Very peculiar thing, because you come and buy a property. Tomorrow your wife comes and buys a property. Today she will say Sanjeev Shah, he will say Sanjeev Shah, son of so and so. She will come and say so and so, wife, daughter of so and so. If she says the wife of Sanjeev Shah, I will immediately find out. At least I have a chance. I will put in computer and find out. What if she doesn't like to say her husband's name? In their custom they won't say. So she says daughter of. And everywhere she produces her passport, only her father's name is there. PAN card also only father's name is there. Husband's name is not there. How to find out? Right? Now I have raised an even more complex issue. What if I sold to him, then sold to one lady and they both marry? Love marriage. Have I sold to the spouse? On the date of sale they were not spouses. Therefore I have not violated. I really don't know. What if? See, how can I ever find out who is your spouse, I am sorry. Who are your minor children? Of which HUF are you karta? I am a builder, I say. I am a developer. Is this my job? If HUF wants to buy property, I must find out who is karta of that HUF, see whether somebody else has bought from me, and if that person, if it is first HUF, then individual comes, what am I supposed to do? I really don't understand, but there is a condition like this. Only luck is that they did not make it retrospective. Otherwise, last year I sold to him and to his wife. They will tell me, last year you sold to him and his wife, so gone. Luckily, that amendment which was made prospective only, but it is still, I will tell you, near impossible to comply. If my wife is ashamed to call herself my wife, you will lose deduction. Understand? This is what they are talking of. It's simply unfathomable as to how they could think of such an amendment. I know how to beat this also. What is the big deal? First I will tell to sell to Sanjeev Shah. Then I will sell to his sister. His sister will gift it to Sanjeev Shah tomorrow. What is the problem? I didn't sell to him, no. 10,000 rupees I will give discount to him. Finished. Property deal over. Now what will department do? What can the department do? They can't do a thing. Well, all that confusion aside, to beat this is a very easy thing. Now the whole problem is, a person who wants to beat it will beat it. A person who does not know will innocuously get caught. And he will suffer. Of course, I have no complaints on that. That is our survival. The survival of this profession depends on somebody getting caught in the department. It's all right. Now, I have sold to brothers, the brothers have joined the unit. Now, in Sangvi and Doshi, what happened was at that time they did not say more than one unit should not be sold to the same individual. That provision was not there. I sold 2 flats to one individual. That individual very quietly joined both the flats. Department says more than 1500 square feet. I said, I sold it. What can I do if he made structural modifications post my selling it? There also the tribunal said if it is post your selling, if somebody did modification, no problem. In fact, that was a very interesting case where that individual who bought it engaged me only to do the modification. I only did it for him. Tribunal still said you may have done it. That's a separate contract. That was later. You sold 2 less than 1500 units first. Eligible. No problem. Now here the issue is even simpler, 2 brothers. So I don't think there should be much of a difficulty because anyway they are 2 different individuals and it should not be a problem. Next is a case where the assessee is built a hotel and a convention center. That assessee company's shares are acquired by another company. Whether that other company can claim the benefit of 80ID. I will take this along with the last issue where there is a partnership, a proprietary concern which is claiming the deduction under 80IC. The proprietary concern is then converted into a partnership firm. Whether the partnership firm can continue to claim the benefit of 80IC. Now, as far as I'll take the second of it first. As far as second is concerned, there is absolutely no problem. The partnership firm can continue to claim 80IC because if you look at 80IA, 80IB, 80IC or for that matter 10A, 10B, all of them are specific to an undertaking. They are not specific to an assessee. That undertaking will be eligible for 10 years, say. So you continue to claim, so long as that undertaking ownership may go on changing. Even assuming I am running a 10B undertaking and I transfer this undertaking to a company, that company will continue to claim 10B. Reason being, of course 10B is gone now, assuming it were there, it will continue to claim for the reason that the undertaking is an eligible undertaking. The undertaking is not formed by splitting reconstruction, so the benefit would be available. There is a decision now of the Punjab and Haryana High Court in a case called Mega Packagers, which is still not reported. It is reported in one journal called ITCL, Income Tax Case Laws. Not reported in ITR or anywhere. It is in 42 ITCL 374, the Punjab and Haryana High Court, where they say the benefit would continue to be available. Now going to the immediate proceeding issue, it's even simpler. There, even the undertaking did not change hands. The shares of the company which owned the undertaking changed hands. Only that I was the owner of the undertaking so far. Undertaking is still there in that company only. The ownership, the shares of that company have been bought over by somebody else. The benefit should certainly be available in respect of 80ID. There should be no difficulty. In fact, you are one step better than the other. Now, these were just some of the issues which occurred to my mind, which I thought I could discuss. Subject to permission, subject to availability of time, I will try to answer questions. Thank you very much for a patient hearing and the opportunity.
We will take 2 questions.
It's out to the domestic tariff area, and 20% of the work being quality assurance, checking the quality and other things, is done within the STP. The invoicing is done, the export invoicing is done by the STP unit. Would the outsourcing affect the chances of?
In my view, see, the issue is like this. I have a 10A unit which is an STP unit. I am outsourcing work to a domestic assessee who is in a domestic tariff area, not a STP unit. Now, whether the outsourcing will affect and whether it will affect if a substantial part of the work, say 80% of the work, is done by the STP. The answer will be no. I must be engaged in the manufacture or production of an article or thing. I must be engaged in the business of export of computer software. So long as I am in that business, I will be eligible for deduction. Now, let's look at it practically. No company can manufacture. Company can manufacture only through its people. Now, I either do it through my own people or I outsource it. In any case, we will understand that you are not going to see the department makes a big scene about this. In fact, we have cases of the Chennai tribunal, not exactly on 10A or 10B, but on 80IA, 80IB, etc., where they say you outsource the work. What difference does it make to you?
See, the point is, this STP is part of the foreign trade policy. There is a separate chapter for STP.
It allows me to give it for outsourcing.
Up to 60% of the cost
So
of the
long
goods or services.
as I am not violating that and that other person does not question me, who is the income tax department to step in and say, why did you outsource it?
So, if it exceeds the threshold of 60%, then the chances of getting 10A is affected, or
Maybe yes, then the STP with the registration may get withdrawn. If it exceeds that limit which is permitted under the policy, your STP registration is at stake. If that goes, the deduction goes. So long as you are within that policy, who is the department to come in and ask me? In fact, I am arguing a case where it is on 80 IB. I am saying I am a small scale industrial undertaking. Department says no, you are not. But the SSI says I am. Who is the income tax department to determine whether I am SSA or not? That is something that is determined by the IRDA. The IDRA, the Industrial Development and Regulation Act, and the authority constituted, and that lot says yes. He agrees. He has issued me the certificate year after year, he approves me. I would think the department cannot step in and question anything that is happening under the other laws. So long as it is within the realm, my activity has taken place in the STP, and I am claiming the deduction only in respect of value addition that happens in the STP. Because the rest of it, see, supposing I am selling the goods for 100 rupees, I am outsourcing the work to you. You are in a domestic tariff area. You are charging me 70 rupees. That 30 rupees less my expenses is what I am going to get as deduction. So only for the activity which happens in the STP, I am getting the deduction. What is the department's problem?
This relates to 10A. The director travels abroad. He takes the ticket by credit card, pays it by rupees. Yeah, is the see, even the hotel expenses are paid through credit card. He comes back, he settles the dues by Indian rupees. That's the normal thing happens. So, do we deduct the overseas expenses in the profit?
No, the question, the overseas expenses, whether it will get deducted from profit, the answer has to be yes. But whether it will get subtracted from export turnover,
Yeah.
would be the question. Now, there are two things. Before we get into the question of whether it was incurred in foreign currency, was it incurred for the purpose of export of goods or merchandise or computer software outside India? The answer would be no.
He went on a business trip only, no?
Business trip is different from the expenditure incurred in connection or for transfer. If you say on business trip, then all foreign exchange expenses will be in connection with business only.
Correct.
Otherwise, you won't debit it to P&L.
Correct.
Then everything will have to be subtracted. That is not how it is. Only the expenditure which is directly related to the export of goods or merchandise, like freight. These are the items that need to be subtracted. Not the indirect expenses. For example, my salesman might have traveled. Those are not to be subtracted.
Communication expenses also to be deducted. How do you identify telecommunication expenses for a software export?
First of all, is the telecommunication expenditure incurred in foreign currency?
No, I don't think there is a foreign currency limit for a telecommunication. It only says freight or telecommunication expenses in connection with the transfer. That's what it says. It doesn't talk about the.
If we are talking of 10A,
see the 10B,
10A or
export
10B.
turnover explanation.
Just give me one moment. Let me take the section itself so it will be easier. Export turnover means the consideration in respect of export of articles or things or computer software received or brought into India by the SC in convertible foreign exchange, but does not include freight, telecommunication charges or insurance attributable to the delivery of articles or things or computer software outside India, if any, incurred in foreign exchange in providing the technical service outside India. So whether at all it was incurred in foreign currency, I'm reading from the Act, sir.
Can you read it again, please?
It says, but does not include freight, telecommunication charges or insurance attributable to the delivery of articles or things or computer software outside India, or expenses, if any, incurred in foreign currency in foreign exchange in providing the technical service outside India.
See, that or, no, that foreign currency, it interpretation or it comes. And therefore, the expenditure.
Okay. Let me go one step further. What you are trying to say is only for the fees for technical service or the expenditure for technical service, it is foreign exchange. All the rest, even if it is domestic, will get covered.
Because
even if it is in Indian rupee.
Because it is or it says that.
No, that's all right. Let us take that view itself. Now again, that should be directly related to the export of articles or thing or computer software. Now it very clearly says, but does not include freight, telecommunication charges or insurance attributable to the delivery of articles or things or computer software. So only that much of the expenditure which is attributable to the export of the software.
Agreed, but how the officer says, no, please show me how much is attributable to you.
I am not here to show it, you subtract. Why would I have to do that? This is like yesterday in the department, they are telling me, the day before yesterday in the department, in the settlement commission, they were telling me, I do not know the profit of the other party, so I will presume this is the profit of the other party and then do the profit split. I said, if you are going to presume the profit of the other party, that simply means that you cannot apply the profit split method. Why should I demonstrate anything? It is for the department to demonstrate that there is an expenditure that is attributable. I am saying nothing is attributable.
No, sir, I will just complete this. Assuming it will be deducted from export turnover, can it also be reduced from total turnover?
That is a natural offshoot. There are decisions of the Special Bench Chennai, the Delhi High Court and the Karnataka High Court, which I have referred to earlier. The Chennai Special Bench is in Sackcroft, the Karnataka High Court is in Tata LC, the Delhi High Court, I don't remember the name immediately. There are 3 decisions in favor of SSC on that point.
Does not include the telecommunication charges, as contrasted to a sale of goods where there could be an FOB basis or a CIF basis. There is no such.
Shrikant, the turnover itself does not include the telecommunication charges is definitely a good point. In fact, we have been taking this, but department says, after all, when you are showing a profit, that means you have recovered all your overheads. And your overheads is part of already included in your sales, therefore it is already credited to P&L. Peculiar theory. May not.
Sir, I am developing commercial complexes, claiming reductions under ATIA. Now, for selling the commercial complexes, it has to be leased out, and then only I am able to find the buyer. During the intermediate period, I am receiving some rents. Whether this rent should be treated as income from ATIA or not.
Now, under what clause of ATIA are you claiming this reduction? What are you developing?
I am developing industrial parks.
You are developing industrial parks. Then it is very much derived from the activity of developing industrial parks and should be eligible for the reduction.
But the department is claiming that
if you tell me that the department does not agree, fight. This is my view of the matter. Well, department and if we always agree, then what do we all do? If the assessee and the department are going to agree to everything, what is our role then? How do we survive? That's good for us. Sir, I know you are not in practice, you are in industry, so you should be a little worried, but we are not. We are extremely delighted.
Thank you, sir.
and it was a wonderful session per se, and we are having the next speaker. Before going to the next speaker for the day, I would perform the pleasant task of presenting a memento on behalf of one and all present here. Yesterday, after the session was over, with reference to the views of the department and the views of the chartered accountants, there was some argument in between, and we remarked that they have their own reason. It is just like a son being advised by a father and the son not heeding to the advice, and the father who happens to be the son of his other father who is very aged, and from him the same father, if he is going to advise him, he is not going to heed, because they are in two different thought processes, and they don't understand that the person who is advising has put his thought into that particular process, and then they are advising. That is, if at all you as a person is going to just say your son, do this, he does not understand that you have thought about what is going to happen, and then only you are saying, and it goes like that. Everyone is having that particular impact of first saying no, then saying yes. Hence, that is the way in which it goes. That was some argument outside. We want to just say that the reason we said is everyone has their own view, and if at all they have such views, then only we have our expertise put into that particular area. And all people are having six senses, and we chartered accountants should exhibit our seventh sense, that is Edamarivu. With that as a prelude, now I take this opportunity to introduce the speaker of the second session, R. Raghunathan. R. Raghunathan is a fellow member of the Institute of Chartered Accountants of India, graduated from Guru Nanak College, Chennai in 1975. He was a gold medalist in MCOM examination of Sri Venkateswara University, having obtained the university first rank. A rank holder in CA Inter as well as CA final examination, he secured the All India 5th rank in CA final examination. He is also an associate member of the Institute of Cost and Works Accountants of India. He has completed ISA course of our institute. He has been in private practice since 1979. Currently, he is specializing in the direct taxes consultation and insurance investigation. And Raghunathan has been the secretary of Salem branch of the Institute of Chartered Accountants of India for 6 years. He has chaired several sessions in taxation seminar and conferences, and has presented papers in several conferences and seminars. He has written more than 400 articles on taxation, which has been published in all leading taxation journals in India. He has authored for 17 books on direct taxes, which are reference books used by CAs, lawyers, and other professionals. R. Raghunathan was a member of the editorial board of the Current Tax Reporter, popularly known as CTR, which has the second largest circulation in India amongst tax journals like ITR, Taxman, and Taxation, etc. He is blessed with 2 daughters who have embraced the IT field. His wife is a homemaker. I present before you C.A. Raghunathan for the next session.
In the context of ATIA units, SEZ and EOU units, maybe I will add little points at the end, towards the end of my session. Let me come to the main topic straight away. I have given you a background material to you. I have made it clear in the initial portion of the background material that I am not going to cover the conventional areas in the unabsorbed depreciation and business losses. No issue. I may go to sleep. So, okay. I would like this to be an interactive session in the sense that I may pose you some questions once in a while, and I would like your feedback on that. So that way, instead of a one-way process, it could be a two-way process, and whatever issues you have in mind, we can trash them out then and there. The first issue I have taken up is relating to the losses which are covered by specified businesses under section 35 AD. Then normally we understand that for a business loss to be eligible for being carried forward, it is imperative that the return of income should be filed within the due date specified in subsection 1 of section 139. The question is, for a loss which is covered by section 35 AD, is it required that you must file the return of income within the due date which is laid down in subsection 1 of section 139? How many of you feel that it is required? Do I take it that all of you are absolutely clear that it's not a precondition that the return of income should be filed within the due date for carry forward of the loss which is covered by 35 AD? No answers for that also? Would like to take a neutral stand? Anyway, the answer is that there is absolutely no requirement for first point you have to note is that such a loss is covered by section 73A, and all of us know that as regards the set of carry forward of business losses, there are two principal sections, provisions of the Act which are involved. One is section 80, another one is subsection 3 of section 139. Now, we'll first see what this section 80 says. Now, what does section 80 say? Section 80 says that no loss which is not determined in pursuance of a return filed under 139(3) is eligible for carried forward as long as such losses are those which are covered by section 72(1) or 73(2) or 74(1), so on and so forth. I listed them out. Okay. Now, what about a loss which is determined as per the return which is filed under section 139 subsection 3? Now, if you see that subsection 3 of 139, it mandates that the set off and carry forward of certain losses only if the return is filed within the due date as specified in subsection 1 of 139. Okay, what are all the sections which this 139(3) is covering? This subsection is also not speaking about a losses which are specified in section 73A. So the conclusion is that it is not a precondition that the return of income should be filed within the due date specified in 139(1) in order to enjoy the benefit of carry forward of the losses covered by section 35 AD. All of us know that these losses covered by section 35 AD, there are two peculiarities. One thing is such a loss can be set off only against income from some other specified business which is covered by 35 AD, and also there is no time limit for carry forward. It is like a unabsorbed depreciation. So this is my conclusion. I am concluding that even if the return is not filed within the due date, the carry forward is not going to be affected. Now, we will take up the next controversial area. Normally, how we understand is that a brought forward business loss can be set off only against income under the head profits and gains of business or profession. Now, what happens to a situation where I have a brought forward business loss? Am I eligible to set it off under income which has been assessed under some other head? Is it possible? How many of you feel it is possible and how many of you feel it is not possible? Anybody feeling that it is possible? I have a brought forward business loss. I want to set it off against some income which is assessed under a head other than profits and gains of business or profession. Do you think it is possible? Yes? No? No? How many of you say no? Do I take it that the others say yes? Those saying yes will have to tell me why. Okay, let me put it to you this way also. Supposing in this year, I have some negative figure. Ultimately, the income is determined at a negative figure. This happens to be something which is not assessed under the head profits and gains of business or profession. We will say it is not also house property. We will also take it that it pertains to the activities carried on in the business, but it is not assessed as profits and gains of business or profession. Am I eligible to carry forward such losses to the subsequent year? Then the other situation is I have a brought forward business losses. Can I set it off against income which has been assessed under some? Okay, at least some of my friends here told me that it is not possible. Sir, can you tell me why? Somebody? What do you feel it is not possible? Anybody? What do you feel that it is not possible to set off? I have some brought forward business loss. Is it a precondition that such a brought forward business loss can be set off only against income which is assessed under the head profits and gains of business or profession? Which section, sir? Oh, okay. You're talking about probably section 72. But see, this is a normal misconception which we have. So that is the reason why I took it up in my subject matter of discussion. Okay. See, these are the problem areas which I have chosen. One is the income is assessed under some other head in the current year. Let us say that I had some factory buildings. I sold those factory buildings. The block vanished, as a consequence of which I have a short-term capital loss assessed under section 50. Am I eligible to carry forward this figure as a business loss? You think on those lines. The second issue is, in the succeeding year, I have some income which is assessed under some other head. can I adjust the brought forward business loss against such income? My answer is that, see, depending on the situations, it could be possible. It is certainly possible. See, in this context, I just flashed on you the decision in the case of this Digital Electronics Limited, which has been recently reported. It's there in the background material also. So this was a very classic case in which there was a brought forward business loss. In the current year, the assessee derived some profit by sale of some factory buildings or some assets, depreciable assets, which was assessed as short-term capital gains by applying the provisions of Section 50. Can we adjust the brought forward business losses against this STCG? See, mind you, it is not assessed under the head profits and gains of business or profession. You have to compulsorily show it as a short-term capital gain under Section 50. It is assessed under some other head. So is it possible? In this particular case, the assessee, he relied on an earlier decision of the tribunal. I have given you the citation of that. It's an unreported judgment, tribunal order. The assessee relied on a case in JK Chemicals Limited versus ACIT. See, that was a case in which I told you the reverse situation. The assessee, he derived some loss by selling some factory assets. The question arose whether such loss could be carried forward as if it were a business loss. Please understand the question. The assessee wanted that to be carried forward as if it were a business loss. And the tribunal upheld the claim of the assessee, saying that the loss arose on account of the business assets of the assessee, and in such a situation, any loss which is associated with the sale of the business assets should be treated only as a loss arising from the carrying on of the business or profession. And despite the fact that you are assessing it under Section 50 as short-term capital gains or short-term capital loss, as commonly understood, the assessee is still eligible to carry it forward as if it were a business loss. The locus classicus on this particular topic is a Supreme Court decision which is governed in the case of a old Supreme Court decision which is covered in the case of one Kokanada Radhasamy Limited. It is in 51 ITR. I have given you the citation in my background material. That was a classic case in which the bank, somebody who is engaged in the banking business, you get some profit or loss by dealing in the securities. All of us know that the banks will have to keep certain securities, make investment in some securities. What about the profit or loss which I make from the securities? During that intervening period, they had one head called the interest on securities then. That head interest on securities is no longer in the statute book. A question arose whether the income or loss which is shown in the head interest on securities will have to be treated as a business loss for the purpose of set off or carry forward. The Supreme Court answered in the affirmative in favor of the taxpayer, saying that despite the fact that it is separately assessed under a head called interest on securities, the securities being stock in trade of the assessee, any income or loss associated with it will have to be deemed to be business income or business loss as the case may be.